Hello, hello, hello. Oh, the lighting here is terrible. Um, well, I guess it won't really matter when since I'll pull up the PowerPoint. It's gotten very dark. Not only has the sun gone down, but we have a tropical depression passing through New England, or maybe to the west of New England. Whatever. Anyway, we do have exciting weather. Um, uh, the life just keeps getting more and more exciting. What can I say? And it's all good as long as we have dogs. My dog, Corduroy, is somewhere. Oh my, it is really dark out there all of a sudden. Yeah, I mean, I sat down to my computer a little while ago, half an hour ago. They were having a sale, and I had given my lightweight jacket to daughter when she went off to India. I told her, oh, I'll just get another one for myself. And they're having a big sale. Plus, I could use my wife's points or whatever at the rei.com. Anyway, I got a nice jacket. And it was all right. And now, you hear in the background water pouring down on the roof. Oh, well, that's what's going on. Now, here's a lovely picture of two. I think all dogs are beautiful. But there are two adorable looking dogs, some more in the background, and a nice sky, nice picture. And here are some more. I always enjoy it so much when students send me pictures of their animals. I think I got, how many did I get this semester? 120 or so. 4 or 5 per lecture, and some students send me more than one. So figure about 100 separate students send me animal pictures, which is cool. I always like them. Thank you. And dog and cat. Our previous poodle, Beowulf, did get along with the cats. He kind of grew up with them. Corduroy showed up. We already had cats, and also his idea of fun is to play chase. So it's been a little iffy. Okay, financial markets and what they're supposed to do. A lot of you are going to college and in the Eisenberg School, or wherever, with the idea that you will then go down to Wall Street and maybe to Boston's downtown financial district, maybe someplace else, and then get a job at a bank and make a lot of money. When I came out of college, it wasn't what I wanted to do, but I did want a job. So I interviewed with various banks, and it was quite interesting. Having lunch, dinner with these people at fancy restaurants, and being offered really pretty cushy jobs. Instead, I took a job at a labor union on the research staff, and worked for 1 year, just about 12 months, maybe 13 months, as on the research staff. Took the money I made and had saved and went to Europe for a month and a half, then went on to graduate school. And that was my 1 year of honest labor as somebody who was in the office on time and left on the end of the day. Didn't make nearly as much money as I would have working for a bank, but yeah, I did okay. and I've done fine since. So, okay, a bunch of videos about financial markets, risk, uncertainty, asymmetric information. Ooh, when your parents ask you, what did you learn in school today? Tell them you learned about asymmetric information. That should blow them away. Keep them quiet for a while. But it's also really, really, really important. Really important for financial markets, really important throughout the entire field of economics and business. I think it would be not unreasonable to say that asymmetric information has been the major contribution of orthodox economics over the last 50 years. I'm not sure I would say that orthodox economics has contributed anything of comparable significance to understanding the economy and microeconomics. Asymmetric information is the biggest thing. Goes back to Kenneth Arrow, Joseph Stiglitz. These are Nobel Prize winners. Besides asymmetric information, within the field of orthodox economics, transactions course, which is Ronald Coase, public goods, which is also Coase, also in asymmetric information, if you're interested. Michael Spence was another one. It goes on. These are the major contributions that have been made in orthodox economics. George Akerlof, of course, we'll actually be talking about him later. These are all Nobel Prize winners, and these are people I think actually deserved the Nobel Prize. I'm not going to comment on, give you a list of those who did not deserve the Nobel Prize, but okay. Move on. Okay, quiz 21, discussion 2. Okay, that is the last discussion. Big ideas. Financial markets provide liquidity to spend more than you hold in hand. This is what they do. Liquidity allows transfer of wealth across states of the world, between a state of the world where you want to spend money, from a state of the world where you have the money. Well, I should have done it the other way. Between a state of the world where you have more money than you want to spend to a state of the world where you want to spend more than you have. Right now, you're in college. You want to spend more money than you have. So you need liquidity. And you get that from some other state of the world where in the future, you will be you'll have more money. I had money during the time that I was working. I wanted to spend it during the summer after I left the job so that I could work, so that I could travel to Europe. And during the time that I was working, I put the money in a bank. That bank then transferred the money to me. During the time that I had the money, the bank lent it out, providing liquidity to somebody else who wanted to take a vacation. I didn't want to borrow to take a vacation. The person I went with did borrow to take that vacation. Oh well, did not end. That relationship did not end well, which was fine. I mean, I met my wife in high school and I was in love with her all this time. So, but I do kind of feel bad that we didn't end well. Okay. Turn savings into productive assets. You have money, you put it in the bank, or you buy a corporate bond that allows a business to spend more money than it has. You're providing liquidity to that business. You could transfer money across states of the world where you are healthy to a state of the world where you're sick. You buy an insurance policy. You buy an insurance policy on your house, or your car, or your dog, we have health insurance for Corduroy. He needs it. So you're transferring states of liquidity resources from worlds where you have more money than you need to worlds where you need more money than you have. Now, the orthodox assume financial markets will efficiently price assets at an expected value using all available information. They will price assets fairly. So assets, shares in a company, bonds in a company, debts incurred by individuals or businesses. All of those will be priced at the expected value. Kind of like, okay, what do we think this thing is really worth? And they'll use all available information to do that. And risk neutral investors, they don't care about risk. They just, they're just, okay, if there's a 50% chance of this happening and we'll pay off $100 and a 50% chance of that happening and we'll pay off $0, then that is worth 50% of 100 plus 50% of 0 or $50. And they'll buy it at that. Anybody who tries to buy it at a lower price because they're nervous, oh, I value the risk more than the gains. Normal people do that. They are risk averse. They won't be able to buy the asset. The price will be bid up to the $50. If you tried to sell it more than $50, nobody would buy it. Risk averse people wouldn't buy it. The risk neutral people wouldn't buy it. Nobody would buy it. So it will be priced at $50. At that price, nobody will make an unusual profit. You'll get the normal rate of return. Competition in competitive markets will ensure that financial assets are priced at the fair market price. Doesn't happen. And it doesn't happen because of asymmetric information. Some people know more than other people. They may know more a day in advance. They may have insider information. They may just lie in selling it to you. Yeah. Because of that, markets are not efficient. Some people make more money than is fair. And our financial system is chronically vulnerable. Okay, why we care? Of course you care, because you want to get a good job at Bank of America or Chase or JP Morgan Chase or wherever. But apart from wanting to get a good job, financial markets are a growing share of the economy. This is what we do in this country. Increasingly, it's not the only thing. We also do entertainment. We also do other legal services and business services. We also do biotech, especially in Massachusetts. And we also do computers and high tech. In New York City, we do all of them. In Boston, we do the biotech, a little bit of financial. In California, we do high tech computers, and we do entertainment. There are an even faster growing share of profits and wages because financial markets generally produce more profits than other industries. The one exception is pharmaceuticals, which has consistently been the most profitable industry in the US. Because of asymmetric information, financial markets become cause of macroeconomic instability. That's another thing you can tell your parents you learned. And opportunity for fraud, massive fraud. Oops. Okay. Asymmetric information is basically just a fancy word for lying. And it happens. Washington Mutual, a bank that you guys haven't heard of, but it was one of the big dominoes that fell in 2008, leading to the general collapse of the financial services sector and the Great Recession or the Lesser Depression. I was telling you to buy junk bonds. Here's Bernie Madoff who also his financial empire. He's founder and president of the NASDAQ stock exchange. And he just lied. He just lied. And people kept giving him money to manage. I don't say people giving him money to manage billions and billions of dollars to manage, and not just people. Major institutions were lining up to asking him, will you manage our money for us? Brandeis University, Hadassah, and many, many others, on the order of 50-60 billion dollars, something like that he had under management. And a great, lot of that was just lost. Enron, Google Enron. Liquidity, what financial markets do. Consumption beyond current income. Future consumption from current income. I have the money now, but I'm going to want to spend it later. So I'll put it into a financial asset and it will be there when I need it. And in the meantime, I'm letting somebody else spend that money. And for the privilege of spending my money, they will give me something. And that allows me to transfer consumption over time. And of course, states of nature, a state of nature where I'm healthy to a state of nature where I'm not healthy. Financial markets sell trust. I mean, that's what liquidity is all about. I'm putting my money into an asset so that somebody else can spend that money now. And for the privilege of spending my money now, using my liquidity, they pay me something. Okay. Who's arranging this transfer? The transfer is being arranged by a bank or some other financial intermediary. And I am giving them control over my money. I'm trusting them. Somebody goes to them, a business, an individual goes to them asking to borrow money. And they're trusting that when they sign a contract with these people, they will actually be given the money that they're asking for. And the financial intermediary is trusting that those people will make the payments that they're committing to. Trust, trust, trust. Everybody has to trust each other. The markets only work if there's trust. We have a guy, a UMass Eisenberg PhD, who manages our money. I'm very lazy about this and way too aware of how little I know about, what's a good price for a bond these days, whatever. So he handles it. And it's off my plate. I don't have to think about it. I can concentrate on preparing these lectures. We trust him. Took a while, spent time together, talked to him, and we trust him. Other people I wouldn't deal with. I very likely am paying this guy more than I might pay somebody else. Maybe I could find somebody for less, but I trust this guy. Therefore, I'm not looking to move to somebody else. Is he charging too much? I don't think he's charging too much, but he has a nice house. Okay, instruments of financial markets, bonds, equity, mutual funds, and risk. And we've got a couple of terms now that are important. Asymmetric information, trust, risk. Bonds have the lowest risk. You buy a corporate bond, company makes a promise that we're going to pay you a certain amount every year, every month, or whatever period of time until we pay you back with a certain rate of interest. Treasury bonds, the federal government. Treasury bonds are longer term assets from the Treasury. Shorter terms are bills. Treasury borrows money today, 7-day bill, 30-day bill, whatever, they're going to pay it back very quickly, but all with interest, certain return in a certain time. generally low risk. The only real risk is bankruptcy. Now, that could happen. Even governments can go bankrupt. They used to go bankrupt all the time. But what's his name? Charles Dickens invested in Mississippi government bonds and some other state government bonds in the 1830s, and a lot of them defaulted, went bankrupt. He hated Americans. Loans are like this. So you or your parents have a home mortgage, borrowed money from a bank, promising to pay a certain amount back every year for a period of time until it's all paid back. These are bonds secured by the home. Secured means if you don't make the payment, they can seize the home. Mutual funds. We all put our money together so that we can invest in a lot of things, even though even though we don't have that much money. So you may have $1,000, you put it into a mutual fund, you could spread it around a whole lot of different investments, even though the minimum investment in any of these may be $5,000 or something. It allows you to hedge against risk. So you're spread out you have a tiny share of 10, 50, 100 investments. If any one of them goes down, goes into default or fails, then, well, you've lost a tiny bit. If you had put all your money into that one, you'd lose. Now, mind you, when you hedge against risk, you're also minimizing the possibility of a big killing. Because if you put all your money into one thing and it goes down, well, that's terrible. But if it goes up, you've got a big win. That's, of hedging against the downside is also hedging against the upside. Equity, such as stocks. No guarantee of return. This is risky. And to the degree that you invest in the stocks alone, with as against being in a mutual fund, you're really, you're plunging. You're putting yourself into a position where if it goes up, you get a big return. If it goes down, you may lose a lot. Risk is greater, especially if the managers of the business turn out to be crooks, as happened with Enron, as happened with Bernie Madoff, as happened with Washington Mutual, or as happened with Theranos. And oh God, I forget her name, but she's going to jail. She ripped off people for like $700 million in what was it, $7 billion? I don't know. They made a movie about her. Anyway, let's see. So, oh yeah, you can have this Confederate State of America loan. Oh yeah, no, that didn't pay off. On the other hand, loans taken out by the Tsar's government before 1917, the Russian government is making payments on those. Yeah, it's probably stopped since the invasion, since Russia invaded Ukraine, but they were for a while. Okay, consumer jam today with jam tomorrow. Save for jam tomorrow. Yeah, you could put the money under the mattress. You'll have the money, or you could put it into some financial intermediary, lend to somebody else who wants the liquidity now, wants to spend now, and then you'll get, and they'll pay you for the privilege of using your money, borrowing your seed corn. You can make popcorn, or you can plant the corn. Okay, how do you decide whether it's worth it? Should I eat it now, or should I lend it to somebody and get a return? Well, present value depends on your measure of liquidity preference. how much is something worth in the future? What is the present value today in year T, date T, of something that you're going to get next year? The present value of something next year is next year's return divided by 1 plus R, where R is your interest rate. What is your interest rate? You know, your interest rate is probably not the same as mine. Your interest rate may be very low because, well, you expect to live for a long time. Or your interest rate may be very high because you have very strong liquidity preference now because you're short of money now. My interest rate may be high because what the hell, I think I'm not going to live very much longer. I'm an old man, I'm sickly, da da da. Or my interest rate may be very low because I have a lot of cash or other assets, cashable assets, and I don't really need the money, so I have a very low liquidity preference. Yeah, I'm not sure what it's going to be, but whatever your interest rate, your personal interest rate is, that is how you discount future benefits, by that. How do you know how much return you'll get in future years? This is really always an issue. You may think that you're going to make some large amounts of money in the future, in which case you will discount the future by a lot. If you expect that you're going to have some very high rate of return from your investments, then you're going to discount any possible future return by a high interest rate. On the other hand, if you anticipate that, yeah, you're just going to be kind of going along, then you'll be more willing to, put up with low rates of return, depending what you expect. Now, here we have a problem. Let's say everybody in the world has the same information. And let's say 50 of them are thinking about buying a property in the downtown Amherst. And they all know everything that there is to know about this property and how much you're going to be able to rent it out for. In that case, what will the price of that asset be? Well, if they all have the same information, then they may have different rates of return, of discount, but basically the price will be set at the same level. You may have a different rate of return that you expect, so you may not want to buy that, but if your rate of return, if you have a very high discount rate, then you may say, well, there's going to be a lot of money in this thing next year, but I don't care because I have a high discount rate. Well, then you'll be lending your money to somebody else who will then take that money maybe and put it into some other asset. But basically, the price of the asset will be bid up to a level that reflects what everybody knows. So, will you be able to make a profit on that asset, on that piece of land? The price already reflects the future profits. So it's not going to be, you're not going to be able to make any more money than anybody else. Everybody knows that what you know. You're not going to make any money on this. You can never make money by buying things where everybody has the same information. Oh, you'll get your normal rate of return. You'll get a discount rate that reflects some social consensus on the rate of return that we expect for putting money into something, the rate of return on liquidity. But you're not going to make any real profits. You'll make the normal profits. So how can you get rich? Well, you're not going to get rich like that. You're not going to get rich like that. You're not going to get rich by investing in your education and becoming a doctor or a dentist. I mean, you'll do okay. You know, if you have the money to invest, you'll get the normal rate of return, which will be comfortable. But you're not going to get rich. You only get rich if you buy something that at a low price because everybody else thinks it's a stinker. And then when it becomes very profitable, you become really rich and everybody looks at you and says, oh, you're a genius. Well, Steve Jobs bought out one of the two other partners in Apple for, what was it, $1,250 because the guy wanted to go to India. His name is known, it was in a previous lecture I gave, but he's forgotten. Steve Jobs became fabulously rich because he bought something that nobody else thought was worth anything. Bill Gates, another of the world's richest men, bought the QDOS program, Quick and Dirty Operating System, and then hired the guy who wrote it for $25,000 to rewrite it and make it work. So for $75,000, Bill Gates bought what became MS-DOS, the basis of Microsoft. And Bill Gates is worth whatever, $100 billion now. They bought things that other people didn't think were worth much. And because they were lucky buying things at a price higher than anybody else thought they were worth, nobody else was buying Apple, a third of Apple for $1,250. Nobody else thought it was worth anything. Nobody else was buying this program for $75,000. Nobody else thought it was worth anything. But they bought it, these assets, just like you could get rich in real estate if you buy real estate that everybody else thinks is worthless. Put up some money, buy it, and then if you're lucky, it will become a really good investment. But you do this, you get rich, you earn these super high returns because you do the stupid thing. 9 out of 10 or whatever times, people who do the stupid thing lose money. That one time, though, you might become Bill Gates. Financial markets are not about future profitability. If it's about future profitability, everybody else will have figured it out, you know. And it's not about whether the thing will be productive. I mean, as it happens, Microsoft and Apple have been productive. These are successful companies that provide goods and services that people want. But what really makes it profitable for the investors is that they can sell their shares. So hold on here. This is November 2022. Within the last short period of time, Amazon has lost $1 trillion in market value. It's gone from 1.8 trillion down to 800 billion. I mean, it's still a huge profit, a huge company, but it's worth a lot less. If you bought Amazon, do you really care whether it's profitable? I mean, you're buying it because you're hoping that you'll be able to sell your shares in the future. So you're not buying it because it will be profitable. You're buying it because you think somebody else will be willing to pay a lot for it. This is third-degree thinking. You're not saying this is the prettiest person. You're saying this is the person who other people will think is the prettiest person. That's, that's Keynes, by the way. John Maynard Keynes talks about financial markets like this, and he was very good at financial markets. he made a lot of money as managing the money of various institutions. It's not what you think the asset will be worth. It's what you think other people will think the asset will be worth. So, as a financial analyst, it's not about accounting. It's about psychology. What will other people think? Oh, there we go. I did have Keynes in here. Yeah. Since the market's about expectations, it is very volatile. It's going to be much more volatile than the fundamentals of output and profitability, because those tend to move slowly. But expectations can move wildly, especially given asymmetric information, because everybody knows that there are things they don't know about these companies. Everybody knows that somebody's hiding something. So if you find out that if there's some room or whatever, you don't have solid basis to make conclusions. The company says, oh, well, we're going to be making a lot of money. Great. And you look around, do other people believe that? Will other people believe that in the future? Yeah. Here's the Dow Jones Industrial Average over some, short period of time. Look how fast it changed. In a 20-year span. Okay, yeah, there's inflation, but still, it went up over threefold. Do you think that the American economy has grown that fast? Profitability has moved up as a share of the economy, but the big thing is expectations have been that the US economy is going to become even more productive in the future. Here's average annual growth in Dow Jones Industrial Average. The orange line is the average. Some years it's been around the average. A lot of years it's been a lot above the average. 30% growth in 2014. 45% drop in 2008. The market crashes regularly. You look at the dates on some of these headlines: 1929, 1966, 1987. Huge losses on Wall Street. Yeah, and some people, one person jumped. Worthwhile functions of financial markets providing liquidity. This is real. This is useful. Companies need to be able to invest beyond their accumulated profits and cash flow. If we're going to have a well-functioning economy, companies need to be able to plow money into new fields and new products and new production facilities. Individuals and households sometimes need to spend a lot of money: cars, healthcare, education. And so we need liquidity. Liquidity is hard. There's the rate of time preference, discount rate. How much do we prefer ourselves to our future selves? How much do we prefer ourselves to somebody else's future self? Or our future selves to somebody else's present self? And then there's the risk. Are you actually going to pay me? How much do you value the future? Young people, you think, will value the future more than old people because they're more likely to live in it. On the other hand, young people may need the liquidity more. It may be harder for them. That kid may be thinking about, oh boy, how am I going to pay my daycare bill next week? And then there's risk aversion, because we are all, not all, almost all of us choose a bird in hand over two in the bush. We all, or almost all of us, are nervous about the possibility of something really bad happening more than we are happy at the chance of something really good happening. This comes from diminishing marginal utility. You know, some big payoff in the future just isn't worth as much to us as the danger of something really bad happening. The greater the risk, the more return you need to justify the investment. And it's not linear, it's exponential. Yeah, you need a really big payout if the risk of success starts getting low. If we all know the risk, then competitive markets will price investments at a standard rate of discount. If we are risk neutral, or if we all know the future, but we don't know the future, and we are not risk neutral, therefore, competitive markets will not price investments at the established rate of interest, of discount, unless there's somebody who's going to come in who actually is risk neutral to buy up all these assets. In effect, insurance companies or, large financial intermediaries function as insurance companies by buying up the risk so that we don't have to bear it. So I put my money in the bank and I'm guaranteed a certain rate of return on that money. The bank then lends out the money, gambling that it will be able to get a higher return. The difference between what they pay me and that return is profit to them. The profit that they get as a reward for guaranteeing me that I'll get my money and that regular rate of interest back. So the bank is providing insurance for my money. And what keeps the bank's profits in line is competition among different banks, different financial intermediaries. They're all competing with each other for my money, and that bids up the rate of interest they'll pay me and narrows the profit that they get until they get to some point where, okay, this is, I'm not going to pay anymore. This is as much risk, as much the minimum profit that I'll accept, or else I'm just not going to do it. So all these different financial intermediaries compete to get my money. That competition brings the rates of return in line, as long as there's enough competition. Big companies can spread the risk themselves. Insurance companies can absorb their risk. They're risk neutral. They don't care. They don't have diminishing marginal utility for money. A dollar is worth a dollar to them, regardless of how many dollars they have. That's not the way it is for us. If we're poor, then that dollar is worth more. If we're rich, that dollar is worth a lot less. So we pay them, in effect, to take the risk, and they get that profit. In efficient markets, where there's a lot of competition, that will bid down the risk. But that's not the way it works. Competition does not eliminate profits for financial markets. Instead, the financial firms make more and more money. Something's happening. The theory is not working. And the reason it's not working has to do with barriers to entry to financial industries. And the biggest barrier to entry has to do with trust and asymmetric information. And that's what we'll pick up on next time. Okay. I hope you found this interesting. I love it. I love these talks that we have. You know, I mean, I am just as excited about economics as I was when I started out, maybe more so. But anyway, it's still raining out there. Corduroy will need his walk later, but not now. So live long and prosper.